Welcome to this episode of Market Shares. I'm your host, Tony Blodgett, and I'm back with Anton Stetner because we couldn't help ourselves but to get in the studio and talk about what is going on with the bank bailouts, with SVB, as you've all heard about, and other banks that are having to be propped up right now. What does that mean for interest rates? What's the Fed Reserve going to do moving forward? And what is going to be the implication on housing? So, Anton, welcome back to the show.
Thank you.
This is going to be a fun one.
Thank you. It was literally like, hey, Tony, we're going to have this conversation anyway. Let's just record it.
Yeah, exactly. So you guys get to be a fly on the wall while we talk about what is going on in the markets. And I think that there's a lot to unpack. So, I mean, we want to start by talking about what's going on with Silicon Valley Bank, which was, bailed out, essentially shut down and then bailed out by the Federal Reserve. And there's a lot going on around that. So where do you want to start with that conversation? I have some thoughts on it. I'm sure you have some thoughts on it.
Is this the tip of the iceberg?
Well,
is this the beginning? Let's start with some basis and some background. Like, why did this bank go under?
Yeah. So I think this is more the canary in the coal mine. That's the analogy I would use. Yeah. It's a sign of what's going on everywhere. So whether it's the tip of the iceberg, I mean, I guess it's hard to say, but I definitely think it's indicative of challenges that many banks are having. So let's talk a little bit about, and I just want to start off by saying, SVB was a poorly ran bank.
Yep.
Most of their problems are a result of their leadership, the decisions they've made, and how that bank is structured and invested. So I want to start by saying that because obviously every bank is not in the same situation as SVB and some of the others that we're seeing. So I think there definitely is an element here that has to do with how this bank is ran and or regulated. But with that being said, there are some fundamental challenges that all banks are facing and going to continue to face as a result of this whipsaw that we've seen in interest rates, with them going from very low rates to very high rates in such a short period of time. That's going to cause pressure on some banks. And so I want to give some examples of how that could play out in real life and how it has played out here with SVB. Now, one thing that I think is important to talk about to set the stage for this conversation is you have to go all the way back to 2008 during the Obama era and during as Dodd-Frank was kind of being enacted. There was a change to what's called mark-to-market accounting, okay? And so in simple layman's terms, what that means is that, and really it had more to do back then with the value of real estate, but when you have an asset that you plan on holding for, what they say, held till maturity is the language that they use. But if you have an asset that you intend to hold until its maturity, you are not required to change the value of it on any given day due to its current value in the marketplace, because you're going to hold it for the full duration, the full maturity, and eventually you'll get your investment out of it. So let's put this into terms that make sense. So let's say that as an investor, and this is what happened with SVB, they have a lot of their holdings in mortgage-backed securities, some treasuries, and obviously lots of other places that they have their depositors' funds invested, because that's what banks do, right? They take in their deposits and then they invest that money and they hope to earn more money than what they're paying the depositors to have their money in their bank. And we're going to talk more about that in a second, because that's a very widespread problem, and I'll give you some other examples. But let's talk specifically what happened with SVB was around the mortgage-backed securities. So if you're holding a mortgage-backed security that was written a year ago and it's a 2% coupon or a 2.5% coupon, and then today, mortgages are being written into, say, a 5.5% coupon, right? So let's just use a really simple example, just round numbers. These aren't the exact numbers that they dealt with, but it'll help illustrate this. But if I have $1 million of mortgage-backed securities and they're yielding a 3% coupon, Well, that means that I'm making, what, $300,000 on this $1 million the asset that I have. Well, if I were to turn around and sell that today for $300,000, and because it's worth $1 million, that seems like it would be a pretty good deal. The problem is that any investor out there today could be purchasing, if they want to go spend $1 million, they could buy mortgage-backed securities that are yielding closer to 6%.
Or just treasuries.
Or treasuries. And so the point being is that now the value of these is significantly lower. So in this example, why would I spend $1 million if I can get the same return on my investment for $500,000? So here's what happened with Silicon Valley Bank. They have a bunch of their assets that are in that category of we plan on holding these till maturity. So there was no need to write down the value to today's dollars. But what happened is that they found themselves in a situation where they had to liquidate some of these assets. So they had to put out an announcement saying, hey, we're going to sell some of our treasuries, some of our mortgage-backed securities. And through that $23 billion trade, they lost about $2 billion. So not half, but still, they lost a significant amount because they had to write those down to today's
chunk of money.
A big chunk of money. But then everyone looked at it and said, but you have $96 billion worth of those on your books. Like, what is the bank really worth? And it really starts creating this idea that maybe there's some insolvency in the bank, and that created a massive run on the bank. And I think over $40 billion of deposits were withdrawn in a 2-day period of time. That is significantly more than any run that we've seen on a bank, even far outweighing what we saw with WAMU back in 2008. So really what it is this mark-to-market idea, which is not a bad concept, but I think there's going to be a lot of talk about should it be the practice that we use today. But the bottom line is once they had to liquidate those assets and the value was a lot lower, that created the problem. So
it threw up the flag that these assets were on their books, needed to be discounted because of market-to-market had not been discounted. And so everyone goes, well, wait a second, is my money safe?
Right.
We had a classic bank run.
Right. And so what happened today, really, as we started we started the week, the Fed came out and said, we're going to provide, and this is exactly what they should have done, by the way. They came out and they said, we're going to provide a credit facility where we're going to allow you, if you need to liquidate those assets, we will buy them for their face value, of what you paid for them. So if you had $1 million worth of treasuries that yielded 2.5%, they'll pay you the $1 million, even though in today's dollars, they might only be worth $700,000 or $600,000 in that example. And so that is what we call a
bailout.
A bailout. Well, look at that. That's what we call a bailout.
They structured the words differently, but really they're saying, I'm going to take this asset from you at face value, not discounted, which the market would do. And I think it was pretty telling over the weekend how no other bank bought Silicon Valley Bank.
Right.
And PNC was the last one in the race. They're like, nah, just kidding.
Yeah.
We're pulling out. We're gonna wait. So in other words, the Federal Reserve was not going to discount those assets enough, but yet when you turn it around and flip that same coin over, they're going to pay face value for those same discounts. Well, I call that a bailout.
It's definitely, look, there's no question that it's a bailout. Not only is it a bailout, it's also stimulus. It's also quantitative easing.
Yes.
It is all of those things. And here's the question. Is what is the Fed going to do when we're right in a cycle of quantitative tightening? So here we are in this overarching cycle of quantitative tightening, right? That's the Fed has been raising interest rates. They've been selling off their balance sheet. And while in the midst of doing that, they are now doing exactly the opposite by providing this bailout, this quantitative easing, this stimulus. So what do you think that means?
I think the Fed, due to the economic data we just had coming in too hot, too good, I think we were going to get 50 basis points instead of the 25. I think the Fed is now basically playing this game of chicken with the market. Do I lose credibility? Do I stay the course? And see, we don't know where all the chips are going to fall, so we don't know what the Fed's going to do. But I felt like 50 basis points was on the table. I feel like that one's off the table today.
You know, there's been a lot of debate about this, and I don't know the right answer.
And then do you think we're going to have 0 or 25?
Yeah.
Or, because if the Fed pauses, are they basically saying to the rest of the world in that moment, like, hey, we're playing chicken, we're not going to stick to our monetary policy like we said. I feel like they have to give us some, just due to maintaining to the rest of the world that this is how we're going to do it, and we're consistent in our monetary policy regardless of the speed bumps we run into.
Yeah. So I've flip-flopped on this even, throughout the day, as I think about what they're going to do. Look, the Fed just gave testimony last week to Congress, and they were quite hawkish, right?
Yes.
They were still continuing to say that employment numbers are really low, the economic reports are coming in stronger than anticipated. I don't think they can completely abandon that. I think that they should personally, but I don't think they're going to. And so I think they're hoping that putting this credit facility in place, that the words that the president came out and said that, look, your money's safe, if they can calm the fears of what the banks are going through and they can keep their fire hose pointed at this one problem of inflation, I think that's what they're going to do. And as of right now, where I sit today, I have not seen anything that indicates to me that this bank issue is a big enough distraction that they're going to pivot away from inflation and go attack this problem. Yeah. It's not like the mortgage crisis that we saw in 2008. I think that it's a major problem, and I want to talk a little bit more about some of the challenges that banks face and put in just give you guys some examples of some things to think about. But to put a bow on this, I don't think the Fed pivots yet.
Nope.
Do we see a quarter instead of a half, or back to the quarter that maybe a lot of people thought? Yeah, maybe. Yeah. Or they're just going to say, look, just so you know that we're still serious, we're gonna continue our course. So don't be surprised. But I will say this: the predictions for Fed rate hikes through the end of the year, because keep in mind, we're only in March. Yep. So the prediction was that it would be 75 basis points through the end of the year. The current prediction is that we see 75 basis point easing by the end of the year. So does that happen right away? Probably not. But do we see them? I think that, the challenges that banks are facing with these high interest rates aren't going to go away. No. But they need inflation to go away first. So my opinion, they stay on inflation until it's stamped out. I'm guessing we start really seeing that because, and we've talked about on the podcast, the lagging indicators of shelter costs and so on and so forth. I think that we really start seeing that in May and June. That doesn't change. That then gives them the ability to say, look, okay, now we know inflation's at bay. Let's start doing some easing to help the other kind of unintended consequences of our battle that we just had with inflation.
Well, the unintended consequences are massive.
Oh, yeah.
So the Federal Reserve took us from 0, negative, up 400 basis points in 14 months?
Yeah, too fast.
And so the unintended consequences is all of these banks now on their balance sheets, due to mark-to-market, have some sort of, long-term asset that's essentially worth less. And so they have to, and I think we're going to get some regulation on top of this. So they're going to come in and kind of walk around and poke each one of these banks, give them all a little mini stress test, and say, hey, I need you to write down that one right there. Oh, that one over there, we need to write that one down too, because they need to make sure that the whole system is solvent and solid. Secondly, or just to kind of go back to something, you had mentioned President Biden coming on and reassuring the American public. In all bluntness, I don't know if that really helped. Like maybe we should have just kept him off to the side for a second, because I watched his speech and I was like, yeah, I'm not really inspired.
It wasn't really
this.
convincing. Yeah, no, I agree. Well, I want to give you guys an example of a pressure that banks are feeling. This is just one, again, simple illustration, but let's just say that you were a homeowner that owned some real estate and you sold it, in the last year, and you found yourself with $1 million, okay? And you took that $1 million a year ago and you put it in your savings account. And that $1 million in your savings account was earning all of 0.01%, let's just say, as an example. And so here you have your $1 million at your bank, and it's earning 0.01%. And what does your bank do with that money? Well, we just learned about it, right? They take that money and they invest it in treasuries, or they do car loans, or they do other business loans or whatever. But let's just assume that they lent all that money out, for a simple illustration, on some automobile loans. So they took your $1 million, they're paying you 0.01%, and they lent all your money out to everyone could finance their Escalades or whatever the case may be. And they were offering that at 3.5% interest, 4%, let's just say 4% interest even, for these auto loans about a year ago. That doesn't seem unreasonable.
Nope.
That's about where we were.
We're right on there.
But here's what happened about 6 months ago. I'm a savvy investor. I realized I made all this money in real estate. And then I went and I was talking to my buddy, or I was watching the Market Shares podcast, and I learned that I could put my money into a CD, or I could put it into a preferred deposit account with that same exact banking institution, and now they're going to pay me 4.5%. So now my bank, who I put this $1 million in, I gave them $1 million, they lent it out at 4. I've now moved that money into another part of the same exact bank, and they have to pay me 4.5. Yeah. Now, I don't know if you know how banks make money, but the overall goal here is to bring in money, invest it, and make more than what you're paying out in deposits. Yep. Now, this automobile loan probably has a 3, 4, 5, 6 year maturity, and I can invest over here, and park my money, and you're paying me 4.5%. So multiply that times the billions and billions and trillions of dollars in the banking system, and you can see that besides this whole mark-to-market issue we were talking about, and the potential, underwater nature of these investments that they have held till maturity, they have other cash. That's a cash flow situation. If I'm that investor, I'm getting money deposited in my savings account every single month at 4.5% interest, and they're only collecting 3.5% or 4% on that automobile loan that they lent it out on. That's a problem, and it's happening everywhere. Now, good banks will make up for that, right? They'll do HELOCs. They'll do other higher interest rate investments, and they'll have multiple different durations, etc. But you can see where the challenge is to navigate these waters with really high interest rates. And it's not just that it's high interest rates. It's that it happened over 14 months. Bingo. And that's where everything moves around, and they can't move their funds fast enough. So look, I do think that the Fed's going to do what they need to do to give everyone a sense of security that the banks are stable and solvent. But that's just another one small anecdotal, evidence of the pressures that banks are under. And the Feds will have to bring rates down as soon as they can. Let's put it that way.
Yeah, I think, one, banks are in the business of an arbitrage. So
right.
I borrow the money, and then I need to make 0.5 point, 2 points, 3 points more by loaning it out to someone else. The second thing that's attacking their natural arbitrage business is actually just U.S. Treasuries. So let's go to the customer that doesn't have the $1 million, so they can't get that preferred, savings account, CD, or something of that nature. They look down the road and they go, wait a second, I can get like 4% in a Treasury. So banks are running into the classic savings and loan crisis that we actually had back in the early 80s, where depositors look around and go, wait a second, I can make much more safer in treasuries. And so they start to pull their deposits out, creating that liquidity pinch for banks. So then banks start to have to offer these higher rate accounts, thus exasperating the problem.
Well, 100%. Well, and not only, that's just one of the, we could go on probably for an hour of the challenges that banks are going to face in this market, and the question is how does it play out in real time? So, I think another challenge that's going to happen right now, and this is interesting, is around I have some anecdotal evidence. Those of you that watch the podcast or know me personally or know Anton, you probably saw the other day that I had a Polaris Ranger that was stolen from my property. It was a horrible thing. But 2 weeks later, it was actually found on Anton's property, and he called me. And you'd have to go look at our Facebook and see that. But here's my point of the story: is I went into the dealership to look at replacing my Ranger. Yeah. And I went in there, and I was there about a year ago, and we'd bought a dirt bike for my son or whatever, and the place was empty. Yeah. You couldn't get anything. And I walked in there a couple weeks ago, and this is anecdotal, I get it, but Anton, I've never seen so many dirt bikes, quads, and side-by-side. I mean, the place was packed to the gills. And I asked the guy, I said, this looks like a lot of inventory. He said, Tony, this is more inventory than we've ever had in the store. And so my point is that when you talk about people taking their money and moving it into treasuries, right? Yep. Or they're putting it into a preferred deposit account or a CD, that's money that if I was earning zero on it, I might have went and spent it. But because I'm putting it into something that's earning me a rate of return, it's kind of like we're seeing levels of savings go way up. And when savings goes up, it's taking money out of the economy. Okay, so that's taking money out of the economy. Inflation being up over the last year is taking money out because it costs families more for groceries and gas and all the travel and all the things that they do. So there's less dollars there. So we start pulling it's like hungry hippo. We're just taking money out of the economy, but at the same time, inventories are going up like crazy because the supply chain issues are now behind us, right? And we're going to see this. And what causes inflation to happen? Well, it's too few dollars chasing too many goods. It's too many dollars chasing too few goods. But now when you take all that money off the table, now we have too few dollars chasing too many goods, and they have to drop their prices to entice those that are still in the market to buy. And there's going to be massive inventory. So I personally believe the Fed can chill out on inflation because I think that I think inflation is going to come down already. I think we're already seeing the signs of it. I could be wrong, but I think that they've done their job. The problem is they're not going to stop until it's like obvious that it's stamped out and gone. And maybe that's the right move.
That resurgence.
They're
just popping back up like a wildfire.
Exactly. But I just think there's enough out there to prove to us that's not going to happen. And I just worry that if they stay this course, when you can, we've talked about lagging indicators. There's so many lagging indicators that go into this inflation number that we're looking in the rearview mirror on some of this stuff, you know?
We are looking in the rearview mirror the whole time.
Yeah.
And the Fed is just starting to see. So this banking crisis problem that they had to just backstop is the first major thing that the Fed has officially broken with their tightening monetary policy. If this is the first thing we've seen, it means there are others right behind it. So you mentioned, motorbikes and ATVs and stuff like that. So that recreational motorsports, that's going to be a problem. Autos, going to be a problem. If you go look at auto inventories, both of us like Jeeps, you can see Jeep sitting at like 120 days of inventory, the most of any manufacturer right now. And then there's some manufacturers, I forget who it was like Toyota or someone like that, was still at the bottom of the list with barely any. So those supply chains are catching up, and then in some areas they're starting to stack up, which of course will cause prices to come down. So I agree with you. The Fed is winning. They're winning the battle. The problem is does Mr. Powell think he's Volcker incarnate and wants to keep going?
Turns out that he does.
And how far is he going to go? And I think they're going to go too far because they've already proven they can turn on the money printers and just clean it up. So I think they're going to go too far, break a few more things, don't know what they are, but something else is coming, and then they'll come through and clean it back up again.
Well, there's no doubt that that's what they're going to do. And the reason why we can say that with confidence is because that's what they've done. I mean, they did it with the stimulus, right? COVID hit, we needed stimulus. They way overdid it. They were still buying mortgage-backed securities and treasuries. They were still really into quantitative easing while inflation was already going up. Like, they should have stopped months before that. They kind of created a lot of this inflation by continuing to push. So there's no question they'll do it on the other way coming down, maybe even worse. But it's funny because I didn't see this banking. I don't think anyone saw this banking thing happen. No. Well, someone did, because if you look at the regional bank prices, stock's been falling for like the last 9 weeks in a row. So someone saw it happening, but I certainly didn't. Well, I think we covered covered the things that were on my list. Look, we
was mine
talked
too.
about what's going on with the banks, and we gave you some specific information about SVB, and also just some education on the pressures that banks are feeling. It's complicated stuff, I know. I hope that we unpacked in a way that makes sense for you. We talked about what the Fed's going to do. Look, they're probably not going to pivot overnight. I mean, it's if you think that's what's going to happen, I just don't think it's enough right now. I think what they've put in place is going to get them to say we're going to continue on inflation. But I think May, June, you start seeing good signs that inflation is beyond us. That's going to help rates. The Feds are going to then say, hey, we have some ammo built up. We can let some of this go and start fixing some of these other unintended consequences. You guys, that means low interest rates as far as I can tell as we get towards the end of the year and into next year. That hasn't changed. We might see a little juice earlier, which is welcome and perfect timing for the spring home buying market. But your window of opportunity because of the inventory issue is closing quickly. And then we talked about rates and housing. You guys, this has been a great episode. This might be 2 episodes. We might we might have to break this one up and we'll drop one early and then one maybe during our normal time on Friday morning to talk about the housing market. So you guys, thank you for your time and attention. Anton, thanks for reaching out today.
Yes, sir.
And always being willing to come in and talk about the market. And thanks for helping me track down the Ranger. You guys, if you haven't seen it, go to our Facebook page and just watch this story. It's crazy. Here, we own property close by each other, and what are the chances that my stolen vehicle would be
I had
found
nothing to do with it.
He had nothing to do with it. Yeah, no. If it was anybody else, I might question it. But I was just grateful to get that call and to find it. And I've had so many people say, "What a crazy story!" It's interesting. But with that, you guys, I hope you're navigating this market well. I hope you're enjoying market shares and the content that we're bringing to you. If you do, please subscribe to the channel. But more than that, tell people about it so that more people can get this information on a timely manner. And we'll continue to bring you hot topics as they come out, as well as some sales ideas and trends, and trying to just hit all of the different areas that we think bring benefit to the real estate and mortgage community. And until next time, take care.